Hey, welcome to today's video and thanks for joining me. Today we're going to talk about this video. Over-diversification is costing you money and it's giving you a false sense of security. Those are two things you don't need as you're entering retirement. You've got enough worries that you're thinking about all day long. When you're giving us your information to do a retirement plan, one of the areas that we look at is how are you actually invested as you go into retirement. So your big questions that you ask us: do we have enough money? How do we pay less tax? How do we maximize our estate? When do you take CPP? All those are questions that you all are asking. But one of the questions that we're asking you is, are you prepared with your portfolio? Is it invested properly as you enter retirement? So we do a complimentary portfolio review, give you our recommendations. You take that back to your advisor, have a conversation, change your portfolio. Now you've got a portfolio that's ready and you've got a retirement plan. You are absolutely ready. So today I'm going to share with you exactly what does over-diversification mean. Really, there's two areas. One is having too many securities, funds, however you want to label it, having too many of those in your portfolio given the amount of money you have invested. And the second is not having diversity in your selection of securities or funds. So there's two areas and we're going to go into that. So I'm going to show you a real example and then I'm going to show you how to fix all that. So let's get into why you're here today. Over-diversified, it's costing you money and it's also giving you a false sense of security. You know, this is the reason I say that is because you think you're going into retirement with a lot of funds, you're really well diversified. You say, look at how many funds we've got or how many individual positions we've got. We are ready for, a market correction. We're ready for a downturn. We're ready for something to take off. Like, you're totally feeling secure, but in fact, you're not. And I'm going to show you what is it. Here's where I really want you to lean in and pay attention to this. Have a look at your own portfolio and think about this. On the right hand side, there's something called the investment key. And by the way, when we do portfolio reviews, you get this, I think it's 11-page report. And we go deep into your portfolio, show you a whole lot of different things that just other than the correlation matrix here. But this is free. It's a service we provide when we're doing retirement plans. So go ahead and give us a call, email us your portfolio, and we'll provide this information to you. Free of charge, by the way. Okay. You see this here on the right-hand side, you've got 13 different funds. So think of your own portfolio today. I ask people, how did you create your portfolio? And some really know what's going on. And some people say, I don't know, it seemed like, this is what made sense when we talked to our advisor. And after all, you're taking your advisor's advice. This is one of the steps to working with advisors, take their advice. But you've got 13 funds here. And you say, okay, is that too many funds given the amount of money that we have? In this particular case, I think there's about $800,000 being invested. So is that too many funds? No, it's a lot of funds. You could probably get the job done with maybe 7 funds or 8 funds, but 13 is quite a bit. But let's look at what does it really mean. On the left-hand side, you see this vertical axis going 1 and then down to 13 and the same all the way over. So what you're really looking at is to see how much of the underlying securities that are in fund number 1 also exist in fund number 2. So let's just look at the first top vertical axis. Fund number 1 and fund number 2 is 74% related. That means the underlying security in fund number 2 has 74% of the same fund or same underlying securities in fund number 1. If you look at this legend at the bottom, you want to make sure that you don't have anything deep blue or a light shaded blue. You want to try to avoid that as much as possible. What you really want is gray, orange, and the deep orange in your the way you've constructed your portfolio. So let's look at these examples. If we go across to fund number 4 is 100% related or correlated to fund number 3. Fund number 7 is also 96% correlated to fund number 3 and fund number 4, 94% to fund number 2 and fund number 6, I think we're at. If we go, let's move away from 2 and number 7. Let's just go to fund number 12 is 90% correlated to number 9. So what does this really mean? If you're looking at this, and I know you all would love to have this information so you can understand your own portfolios, you could say, this advisor probably thought that if they stuff the person's portfolio with 13 funds, this is going to be well diversified. It's not. It's just absolutely a false sense of security because they're almost all related to one another. There's actually no way of reducing risk to this portfolio. They're all going to go up and down pretty close to one another. This is the danger of having this kind of portfolio construction, is that you feel, because you're taking the advisor's advice, you feel because they've put so many funds in there that you feel like they're doing a great job, and look at how much diversity, look at all the different funds. Actually, all this is really doing is driving up fees for the financial institution, for the advisor. It's just not going to work better or good for you. What you really want, back to this 15 or 20, you could have 15, but the idea is you want them as uncorrelated as possible. So what you really want to see is fund number 1 is 60% or lower to fund number 2, to fund number 3, to fund number 4. Like, you really want them uncorrelated as possible, and yet these are not. So this is what we mean by making sure that as you enter retirement, that you have a withdrawal strategy, that you're optimizing your CPP and old age security, that you're doing your RIF meltdowns and your RSP meltdowns, and you're looking at contributing to TFSAs and pension income splitting, all those things that we do for you. But you also want to take another step and get an advisor. We do this for the people that do retirement plans with us and all of our clients. We do portfolio reviews to make sure that you are armed for retirement, that you're going into retirement with the best possible portfolio. It's easy to do. It's not complicated. Your advisor likely has thousands of different funds to choose from, and stocks and bonds. So there's actually no excuse for this. This is they could do a much better job. Okay, so this is exactly what we do to help you when you get a retirement plan. And there you go. Retirement plan is securing your retirement. So if you're interested in understanding how this works for you, just give us an email. Go on to the rest of the videos on our YouTube channel. You'll see a whole bunch of videos about how we do retirement plans. Take us up on our offer. Do a portfolio review. There's no obligation. There's no cost. We do these every day for people so that you can go into retirement feeling more secure. With that in mind, I want to thank you for tuning into this video. We always appreciate your time. Remember to comment below. Want to read your comments. And I look forward to seeing you in the next video. Thanks, and be well.